What's up, Cookie Monsters? We are here for a tutorial today on some discussions on Fibonacci levels, support levels, resistance levels. There's been a few requests on gaining some more insight. I have a number of materials that's already put together to be able to inform you guys exactly how some of these things work pertaining to the market and how to utilize them for your trading to help advance some opportunities. Uh, so we'll get started here. So again, what's in the jar today? What's in the cookie jar? So we'll talk a little bit about Fibonacci theory. We'll talk about the support levels and the resistance levels and how all three of these can help determine entry opportunities, take profit opportunities, or just kind of standing still until the candlesticks works itself out to reach those levels. So what is a Fibonacci theory? It is a popular terminology that tends to apply to different aspects of life. But particularly in the markets, the Fibonacci numbers are a sequence where each term equals the sum of the previous two, right? So when we add 1 plus 1, we get 2. When we add 1 plus 2, we get 3. When we add 2 plus 3, we get 5. When we add 3 plus 5, we get 8, so on and so forth. But the sequence, there's a bunch of numbers that's in that sequence that we actually utilize in trading. So the 358 is a 358 maximum, minimum to maximum bar sequence, right? So when a candlestick is moving upward or downward, they usually move in a sequence of 358 bars. 8 bars is the max, 10 bars is extreme, and that's when you know a move is extended and we should be seeing a pretty reasonable reversal. So 3 is usually the minimum to build out a trend. 5 is that middle ground, and 8 means that it's starting to work towards an extension level. And then we have the 13, 21, 24. I mean 34, right? So that's the sequence of the moving averages. Those are the moving averages that are on the chart. I personally don't utilize the 13, 21, 34 because that's not how I was taught early on. I was taught the 8, the 20, the 50, the 200. But I do know traders do utilize the 13. Some use the 3 as well. But the 13, 21, 34 are prime moving average numbers in that sequence. And the 55, right? So the 55 is another sequence that pertains to the major retracement levels, right? So if we're using the Fibonacci level and we get usually it's a 50 fib level, but 55 in that range, that means the move is set to either bounce off that level, and you'll see a price rejection off of that. So Fibonacci plays a major role in nature, the universe, various subjects of study, and most definitely finance and investment dealing with technical analysis. It is scientifically proven that Fibonacci sequences tend to provide a pleasure effect on your mind and behavior. Having this understanding will only enhance your understanding of the market when utilizing other tools. So again, like it makes more sense to utilize what's already in sequence, not only scientifically, but just also in the aspects of finance. But it's also a formula that's utilized in nature. So I think when you look at it from that terms or from that perspective, you realize how valuable this theory is and how far it goes. So not to get too heavy on this, but Fibonacci sequence along with the golden ratio of pi, which you can look into for yourself, you'll find this universal truth and power within this natural law. Since it applies to the market, it must be used as being true along with proper guidance and focus. Fib levels are to be used in various ways in the market that can measure the pullback and ultimately the direction of a move. Let's look on to some more pages, for example, right? So in this example, I'm using pound Dorsey, right? So if you look at my chart, we have a nice little pullback into the 200. Then we receive a bottoming tail. If you're not familiar with the bottoming tail and the value of that bottoming tail, you'll see in another video that I do about the ABCs of the candlesticks. The ABC, the candlesticks tells a story. So we see this immediate rejection off of this support level. Now, what am I looking at that's at a support, right? So I'm looking at the 200, that red moving average. Uh, That's a support level, major support too. I should have highlighted that. We get an immediate bounce off of that. We get the candlestick, the bottom and tail, which is a huge candlestick for our significance in the direction of a bullish move and a bullish sentiment. So now we're starting to work price upward. So when we look at and when we scale out our fib levels, we see that the 382 level actually matches with this major resistance area. So when we look at that as a target, we're looking at a potential of 670 pips. So again, when you utilize the fib levels, you're able to identify target opportunities, target locations, and play with it from there. Now, the 382 level is just one level. It can break that level and reach up to the 50 fib level or the 618 level or even higher. It can completely retrace back to the major resistance level. But these are key locations to pay attention to when you're trading, when you have a strong trend that's moved down, primarily when you identify it on a monthly, the weekly, the daily, the higher time frames, it's a little bit, not a little bit, but it's a lot more clear to be able to recognize the price locations utilizing the fibs. So that's one there. So what is support and resistance, right? So support levels, this is the area in which price or range of that security or currency does not go underneath. So again, it doesn't just apply to Forex, this applies to equities, this applies to futures, options, whatever you're trading from a technical standpoint, it applies. So if we are receiving bearish activity coming down where all these red candlesticks coming down, there's a support level that it has to meet. Once it meets that level, it's either gonna push back up and bounce off of that level, or it's gonna break that support level. Um, and then we go into resistance levels. This is the area in which price or range of that security or currency does not go over. So if we're getting bullish activity and the move is moving upward, and then we reach that, then the candlestick reaches that level, price is going to reject, drop down, or it's going to break that resistance level and go higher. Uh, and then one keynote here is what we call role reversal. And role reversal is a term used to explain that a support level has been broken or breached, which now flips the role of the level, right? So if we're talking about support levels, the bears are working this price down, and then it breaks that support level, is no longer support level because the candlesticks and price is now below that support level. So that support level now reverses into a resistance level. So if price pulls all the way down and then it reverses back, it's gonna hit that reverse level, which is now a resistance level, and then maybe either continue downward or break through that resistance level. And the same is opposite if we're going upward. If price breaks up through that resistance level, that resistance level now turns into a support level. So candlesticks may retest these levels a number of times before eventually breaking through, right? So it can keep tapping a resistance level, it can keep tapping a support level, it can keep going back and forth. It can consolidate in those particular locations. But when you're getting that type of activity, um, ultimately over time, that level is going to weaken and the candlesticks are either going to break through it, or it's going to completely run away from it. And we'll see some examples here. So support and resistance in uptrend and downtrend. So if we're getting an uptrend move, a downtrend move, there are still some support levels that needs to be had. There are some resistance levels that need to be paid attention to. The market doesn't particularly move sideways; it moves upward, downward, and then even in sideways activity, there's still things to pay attention to that are important. So you see here in the example, we get a move up, we hit the resistance level, and then we start working our way back down. Then we get a price rejection off of support, we thrust back up, get another resistance level there, and then price reacts, pushes back down, and then we move back up. So support and resistance can only be comparable based on some form of previous pricing locations where pullbacks or retracements took place. So whether you're on a lower time frame such as a 15-minute or a higher time frame such as the daily, you need to look at previous history that's going to be able to identify, okay, this is a support level or resistance level. You'll see me utilize the term major support or major resistance. And what that means is that this was a huge location, probably on a higher time frame, or this is a huge location based off of MAs, moving averages, based off of location, based on activity that's in there, how many times it tapped and retested that level. So you'll see all of that. But again, as I said in the previous slide, the more that area has been retested, the more weaker it becomes. So we see here in the example, the support level, it gets retested 2 times on location 1, and then price immediately shoots up. On this resistance level, it gets tested 4 times before we ultimately break through. Now, again, remember with the role reversals, we break, and now that support level that we had on level 3 turns into a resistance level. So as soon as we break through, price pulls back into that previous support, which is now resistance, in example 4, and then we start working our price downward. But again, these locations, these areas are critical for your trading because you may just be looking at the candlesticks thinking, okay, like I'm good. We got a bottom and tail, we got a top and tail, we got an elephant bar, we have an engulfing bar, a doji, whatever the case is. But you might not be paying attention to the location. And that's the reason why with a lot of my students and just in trading period, I always say it's not just the event. The event is the candlestick, is also about the location. So take and identify the event and a location, pair those together, and you have a clear analysis for your trading. Here, pound dollar, another example. It pulled into a major daily resistance level. So again, the higher the time frame, the major and the more stronger that resistance or support level is. So in here we got a major resistance. We tested this area twice, as you can see, and then price started to work its way downward. And now we have a topping tail to finish off pretty much from when I'm doing this recording from Friday. That's now set to possibly start working its way down into this major support area, or support zone, I should say. And why is it a support zone? It's a support zone because when we look at the activity from February, March of 2020, we see that price kind of had a bounce in that area, and then it broke that area, but then it pulled back. Remember the role reversal, it pulled back into that area again, right into the 200 MA, shot back down, retested the 200 again, shot back down, broke through the 200, but came back, shot back down. So there's something in this zone or this area that's critical and that's important. So the whole zone would be a target. So we're looking at 250 to 345 pip target, particularly on this pound dollar trade. So you want to be able to bring price into that area. Once it gets in that area, start looking to take profit or look for any major reverse opportunities on there. Dollar CAD dailies, right? So again, the moving averages are another critical component that can be utilized for support or resistance. It's not always going to be a price location or a previous candlestick consolidated area. It may just be the MAs that's used. So in this particular example with dollar CAD, we're seeing that we got price pulled into the 50 MA. It shot up and then it pulled back into the 50 MA again before shooting up again. And then we also have a third retest at the 50 MA a little further up that tested the 50 again, and it shot up even further. So again, the MAs are critical. Like you want to pay attention to that. Again, another location type thing. So we see we getting bottom and tails on this, which is our event. But then when we look at the location, where we see that it's coming off of a daily 50 moving average, which is critical. So super important. Support and resistance levels are highly important when it comes to trading. You can use these to set up new entries or take profits. Use it for price ranges, moving average points, or fib levels, and you will ultimately win day in and day out. Rather than being unprepared to take your earned capital out of the market, use these points to help you analyze very clear targets. So again, if you getting into trades, just make sure you're getting in with a full understanding that, okay, I like this candlestick, I like the location, I'm checking for the resistance, support levels. Maybe you put your fib levels on. And again, the fib levels are best on like higher time frames, dailies, um, weeklies, monthlies. You can utilize it on a 4 hour if the move was quite extended, but you want to make sure you utilize all of the components of these levels that help determine targets, entry opportunities, and then price action. So I hope that helps any of you traders out there, um, or people that's looking to get into the market. Definitely insightful stuff. If you haven't already, click that subscribe button, click that like button, share it with a friend or family, and definitely let's continue to eat these cookies in the market, um, and so that we able to feed ourselves and our family and eating good. But yeah, be on the lookout for any other videos that I post, and check out some of my other videos just from my daily analysis, and be on the lookout for my weekly analysis that I post every Sunday. But thank you, and I'll catch you guys later.